Hey there, this is Jacob Wood with Douglas Elliman Real Estate, and I have for you here the Q2 2023 market report for Manhattan from Douglas Elliman and Miller Samuel. Now, the story of our market last quarter was the story of what rising interest rates did to both buyer and seller behavior. We saw a number of transactions contract almost 40% year over year last quarter. Now, we have to remember that's from the historic highs of Q2 2022, but a 40% contraction in number of sales we're gonna feel, and we're feeling it right now. Sellers were also more hesitant to transact as they didn't want to list their homes, sell, and transition into a new home with a new mortgage that's likely 25 basis points higher than what they refinanced into or bought into over the course of the last several years. That has created a more modest 4% reduction in supply. Now, supply was already low last quarter because buyers were buying it up as fast as they could. Last year. It's even lower last quarter because sellers are hesitant to put their homes on the market. Two different problems, but the same result. A lack of oversupply has created a floor on pricing. We see that average price metrics are only about 4% lower than they were a year ago. But that drop was driven almost entirely by the new development submarket. New development comprises only about 10% of the market in Manhattan. A few outliers there one year can skew the numbers the next year. Median resale sales price, the price metric that is most relevant to a plurality of Manhattan buyers, saw a 3.8% appreciation year over year last quarter. That's almost exactly in line with Manhattan's long-term average value appreciation of 4%, which we've seen over the course of the last 50 years. But we have to remember, pricing is trailing data. Homes that closed in Q2 went into contract in Q1. Well, Q1 was still good. Interest rates were about 6 basis points lower than they are now. Silicon Valley Bank was still around. Buyer sentiment was much better. Now, a correction like we're feeling currently, it usually is driven by the luxury submarket. More modestly priced homes feel it a little. Luxury homes feel it a lot. However, because this correction is being driven by an increase in interest rates, it is most felt in the type of home where the buyer is most likely to be getting a mortgage. If you are a $5 million two-bedroom buyer, you're probably not getting a mortgage. At the very least, you don't care what rates are doing. You're going to buy when you want. If you are a $1.5 million two-bed buyer, a six-figure one-bed buyer, you're almost certainly getting a mortgage, and you are almost certainly sensitive to your pre-tax monthly outlay. At a $1.5 million purchase, assuming 20% down, your mortgage payment is around $900 a month higher now than it was 4 months ago. That can knock you out of the market. Whereas if you're a luxury buyer, you're going to be more resilient in the face of rising rates. Speaking of, because luxury buyers are more likely to be cash typically comprises about 40% of the market in Manhattan. Last quarter, almost 2/3 of Manhattan purchases were all cash. That's the highest percentage I have ever seen. What's even more striking is when we stop to consider the implications of that in that 40% activity contraction. If cash buyers are more resilient, that means that buyers reliant on a mortgage have contracted more than that overall 40% total. In fact, there were less than half the number of mortgage buyers last quarter than there were Q2 2022. So, if you are a seller of inventory where your buyer is likely to have a mortgage, that basically Manhattan co-ops below $2 million, your buyer pool has been cut in half in the last 12, 13 months. You have to be cognizant of that in your pricing. Now, in Brooklyn, supply has increased to 3.5 months. That's the absorption rate in Brooklyn now. So the market there is only going to soften so much when there is that little supply, and there has historically been that little supply. In Manhattan, if you are a buyer in the more modestly priced six-figure one beds, 2-3 beds below 2 million, you are likely to see the best opportunity this summer that you have seen over the past several years, or that you are likely to see. Personally, what I've experienced is the buyers that I've met this year have low motivation. They're adopting a wait-and-see approach. But the buyers I've been working with for years that felt priced out of that 2022 market are very active now, and they're finding excellent deals. If you're a seller, it may be worth it to you to wait until September to see what the market does. Historically, after interest rate increases, they don't have to go back down for buyers to return to the market. They just have to plateau. As soon as buyers recognize the new normal, historically, they return to the market, and that could happen as early as this fall. But again, if you're a buyer, this is the most buyer-friendly market, even in Brooklyn, that you're likely to see for some time. This is Jacob Wood with Douglas Elliman Real Estate.